Um, all right, very excited today. We have Harvey, who is my son's baseball coach and also the relationship manager, advisor, family office for Charles Schwab. I've known Aaron for a few years now. We talked investing with him a few times and different things. Where did you go to college? What made you want to go into this field? What does your job entail?
Sure. Well, thanks for having me, Brian. Always a pleasure to talk to students. Went to college at Texas Tech, got a degree in business, a Bachelor of Business Administration. Started off my career in financial services with JP Morgan Chase as a banker and had to do a variety of roles there, some of which was investment management. And then from there, I really decided that was my passion was the financial market. So went to Edward Jones, and that's where I really learned the ins and outs of investing, and then was an independent advisor for a little over a decade. So I actually managed assets for people. And now I work for Charles Schwab in our family office business unit, which is a little bit of a niche type area for Charles Schwab, but it's on the institutional side. So my clients are other advisors.
Okay. That's interesting. So you're, talking with you a little bit about, just at baseball events and that kind of thing about your investing philosophy. I was curious. I thought it was interesting what you told me once before. Just what is your investing philosophy? What are you trying to do long term?
Yeah, so I think it's not a one size fits all approach to investing. Everybody is at a different stage in their life. And so it's really what it boils down to is what is your goal for that money? Is it retirement money? Is your time frame long term? Is it short term? Are you looking to make a quick buck potentially, or is this your nest egg? And so it really depends on that. If you wanted to ask what my specific philosophy is, or what I would tell anybody is, you want to have, well, first of all, start investing as soon as possible. I don't know if y'all talked about the concept of compounding interest, which is similar, but the longer you're invested, the more your money will grow over time, obviously depending on what you're investing in. But for example, if you started when you were 18 years old and just put $100 a month into an S&P 500 mutual fund or ETF, I'd have to run the future value calculation with an assumed rate of return. But the moral of the story is you would have quite a bit of money, and that's just consistently investing over time, time in the market, not timing the market, but that's a longer term approach. The other thing I would say, there are really two things are, the more you start investing and the bigger your portfolio gets, the more you want to diversify it, which will insulate you potentially from down markets, recessions. It's not going to eliminate risk by any stretch, but you don't want all your eggs in one basket is the old adage, and that can be, stocks, that can be real estate, that can be, a variety of things to spread out your risk.
Yeah.
So I would say diversification. And then the other biggest thing is understand what you're investing in. Do your homework. So it's school, and I know homework's not a word people want to hear, but even when you're an adult, don't just invest in something because somebody tells you it's a good idea. Understand what you're investing in. Right. Do the homework, do the research, understand the pros and cons of it.
Yeah. So, and speaking of that, I remember sitting there at a baseball game once talking to your wife, Jody, about real estate that you guys have got into. You guys started investing in real estate as well. How has that been for you? Has that been a good venture to get into? I mean, we're going to be looking at a book next semester where it talks about like 95% of investors don't get into real estate because of tenants and because of whatever things that are happening. So you're one of the 5%. Why did you guys get in there? How's the experience been for you?
Diversification. I mean, at the end of the day, it's another asset class. And I don't know if y'all discussed the different asset classes. There's lots of them, but it's just a different asset class, and it's something that is tangible, right? They're not making any more land, so there's just a finite amount of land. It's something you can hold and touch. That's definitely a longer term proposal, and you have to be willing to put up with the headaches that come along with it, whether it's tenants or replacing, a roof or things like that. There's costs involved. But, real estate's not going anywhere. People have to live someplace.
Right.
You either rent or you own. And, we can get into the minutia of it at maybe another time, but there's certain price points and interest rates that you want to look at.
Yep.
And, where do you want that investment? Is it in an area where you're going to be able to find qualified tenants easily? And what I mean by qualified tenants is someone that's able to actually pay the rent. So,
That's important.
Credit worthy. Yeah, credit worthy, because you don't want to have to flip tenants every so often. That's cost prohibitive. But there's shows you can watch that I would probably avoid. Flip this house or that. I think that's a dangerous. I don't think it's a dangerous game. I think you have to know what you're doing. We don't do that. And that's market specific, where you're able to buy something on, pennies on the dollar, and then
Has there been kind of a learning
leverage your
curve for
money.
you? Has there been a learning curve in buying real estate and kind of like, I mean, obviously you buy a property, you put a tenant in it. Has it been a difficult curve, or has it been like, this is a pretty seamless learning curve?
I wouldn't say seamless. There's always, it's just like your own home. There's always something that happens that goes wrong at the most inopportune time, whether you're on vacation and a pipe busts or the air conditioner stops. And so with that, you have to look at, what are my costs? Now, I don't want to get into tax talk, but you can depreciate that, and all of the money that you put into it is tax deductible, and that's kind of a high level version of it. But
Yeah.
let's put it this way: the more that you can do yourself, the better. Because every time you pick up the phone and call an electrician, HVAC technician, whatever, that's $200 just right there for them to come out, and then whatever the repair might be. So if you're knowledgeable, if you're handy, you can do a lot of it yourself. I can't do, major plumbing or major electrical, but I can definitely paint and fix an outlet, things like that. So I would say do your homework on that and know what to expect if you, I know none of your students own a home right now, but homework might be talk to your parents about what does it take to keep a home functional, and that's going to be the same type of cost involved with any type of rental investment, from the insurance to cover it. You're mortgaging that rental property.
Yeah.
Generally, most people aren't going to pay 100% cash for it. They're going to leverage it and have someone else pay the note. But yeah, I would ask your folks, what are some of the things it costs to keep a house in working order? And that's going to be the exact same.
Well, let me show you this real quick here. Let me move over here. And I know you're a proponent of the stock market, and today in the crypto market, which I know is a fun and crazy world. I mean, it is we call it like the Titan ride of all investing. It feels like, because it's so, but today is a great day. It's August 20th. I mean, everything seems to be up. It's just crazy. What are your thoughts on crypto? Or as a person in a well-established investment company, is crypto something you're like, I'm going to diversify myself into it? Or you're like, I feel like it's a Ponzi scheme?
Yeah, it's a bit of a loaded question. So I'm going to preface all of it with, do I understand crypto on a high level? Yes. Your students probably understand it better than I do. And that's just a byproduct of age. Do I think there's a place for crypto in a diversified portfolio? Absolutely.
Hmm.
And I think we may be talking about that, diversification at some point in time, but it still goes back to that you don't want all your eggs in one basket.
Yeah.
Something that can make you a lot of money quickly can also lose you a lot of money quickly. And that doesn't matter if it's crypto, stock market, or whatever else is out there. I would just keep that in mind. Volatility, which is the ups and downs of the value, is something that goes into your risk tolerance and that you better be prepared to stomach. And I would also say, don't put more money in something and that you're not willing to lose.
Right.
Now that's relative, because I'm a firm believer that if you just take an S&P 500 index, you may lose money initially because we can't time the market, but history has shown us that the market is resilient. It always bounces back, whether it's the Great Depression, the Great Recession, you name it. If you stay invested and you're invested in quality investments, it will come back. Now, crypto, I don't invest in it personally because I don't understand the ins and outs of it, and I want to understand what I own.
Right.
I don't take investment advice from people I don't know per se, because I've found that most people just talk about their winners. They don't ever talk about their losers.
Right.
Whether it's, you got in on the ground floor of Amazon, that's awesome. Or Apple, which none of your students were born when Apple started trading publicly. But, that's a great success story. But for every one of those, there's, and this is going to date me and you, there's a WorldCom, there's, a variety of companies that people were telling other people, hey, this is going to go through the roof, and it didn't. It went bankrupt. It became insolvent. Right. And so that's what I would say. To answer your question specifically, I don't have, I wouldn't say, no, do not invest in crypto. I don't do it, but there's some specific reasons. If you work in the financial securities industry, you have to have your investments at that firm unless you get special permission. And if it's outside of that firm, then Schwab would have to know about it.
Yeah.
And we don't offer crypto at Schwab, so I don't invest in it.
So
and I almost feel like I'm too late to the game anyway.
Well, it's interesting. I mean, like you said, we hold up the big fish. We hold up the big catch that we had. I bought Cardano at $1.12 and it's $2.50 today. So I'm like holding it up, like, yeah, but it's like, there are other ones that haven't been such winners, but it's for the most part, the market's gone up, but who knows? My teacher friend yesterday said in October, everything's supposed to crash. So like, who knows, that the market just feels so unpredictable. But if you're looking at like a predictable investment, there are advantages and disadvantages to mutual funds, or advantages, disadvantages to index funds. If someone were saying you're going to have to be in this camp or this camp, which one would you say 51% of my vote would go to mutual funds, or 51% of my vote would go to index funds? Which one would you slightly lean toward in voting that way?
I would lean towards index funds, or specifically, are we talking about mutual funds specifically?
Yeah, mutual funds or index funds.
Okay, so if we're talking about, because there's mutual funds and then there's ETFs, exchange traded funds.
Okay.
Which is it's like a mutual fund, but it trades on the stock exchange. But for argument's sake, let's just talk about a mutual fund. So there's two types of mutual, well, there's more than that, but for our purposes, there's two types of mutual funds. There's ones that are actively managed, where there's a money manager, and that money manager is picking stocks or bonds or whatever that fund's goal is. And then there's index mutual funds, which are, like the title says, they're tracking an index. So you may have one that tracks the S&P 500. You may have one that tracks the Dow or the Russell 2000 or the Nikkei or whatever, but they're literally just mirroring that index. And what I've found is you can always find actively managed mutual funds that will outperform their benchmark over a certain period of time. So for example, XYZ mutual fund, that's not a specific one, I'm just using a generic term. Let's say it's by prospectus, which I don't know if y'all discussed a prospectus. I don't want to bore you with that, but every mutual fund is registered with the SEC, and it has a prospectus, which is like its buyer's guide, and with all the disclaimers, but it has a benchmark. What is its, is it large cap growth, large cap value, but it compares itself to a benchmark. Like, you know, in sports, you're comparing yourself to other players in terms of stats. Mutual funds are the same way. So you can have an actively managed mutual fund where a money manager is saying, I'm going to choose Verizon over AT&T because I think Verizon has a better upside, or I'm going to choose Ford over Tesla. Whereas over certain time periods, that money manager may outperform his or her benchmark.
Right.
Maybe over a 1 year period, 3 year period, 5 year period. Most large mutual funds, ones that track big indexes, or that's their benchmark, have a very hard time outperforming over what I call a substantial time period. And by substantial, I mean a 10-year time period.
Yeah.
So I would challenge your students to find a large, say a large cap mutual fund, US, and compare it to one that's actively managed, quote, and compare it to an index mutual fund that's indexing that same benchmark, and compare it over a 1, 3, 5, and 10-year period and see which one came out on top.
What do you think would come out on top?
Most of the time it's going to be the index. It's very hard to outperform the market by picking stocks yourselves. Caveat to that being in the large cap space.
Yeah.
And so what I mean by large cap space is if you look at the S&P 500 and all those companies in there, they're very recognizable, you know,
right.
Coke, Verizon, AT&T, 3M, blah, 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 blah. Those are large companies. And so there's plenty of information out there available for them. So there's really no homework to be done per se, as opposed to if you're looking in the small cap space or mid cap space or emerging market space where there's not as, you know, those companies aren't big, they're not well known. You'll have mutual funds in those areas that will outperform their index because there's less information, less people are invested in those stocks. And so there's more opportunity to create what's called alpha, which is the return over the index.
Okay.
In the large cap space, it's very difficult because technology age. I mean, it's not like it was in the 60s where only Wall Street had information on, you know, quarterly returns and things like that. Now you can just Google whatever you want and find it. So
right. Interesting.
I'm an index person.
And I have a sign over there on my wall that is very bland and plain, and it just says low cost index funds, and it's a big huge poster, and it's like it's boring. It's not cool. It doesn't feel hip or cool or anything, but it's like it feels like it's consistent. You know, one of the things, you know, we're looking at here, and I'm not going to go back to crypto. I'll get off of crypto here on you. You know, oops, I'm trying to get off of crypto. It's going back. You know, in investment objectives, we have, you know, TEKS, the Texas Educational Knowledge. These are some terms that they want us to go over. And, you know, investment objectives, you know, a set of goals an investor has, helps an investor manager, an advisor determine what they want to do. You know, in your mind, what does this term mean to you?
Investment objective is, what are you trying to accomplish with your money? Whether it's, is this for retirement? Is this for college? Is it for, you know, your first house? Is it for a swimming pool? What is your goal for that money? It's simple.
Yeah, I agree. You know, is in your house, I'm not sure how your house is, but in my house, my kids ask me about investment. We talk about, I mean, I'm dealing with rental properties. I'm dealing with different things. I teach this class. So, Henry will ask me a question about, this or that regarding our rental property, or about, I'll be coming in like, oh man, this stock is up, or this thing is up, or whatever. Do you guys have those discussions you have around your kitchen table, or is it leave work at work?
No, they ask about it a little bit. It's, our Henry and my son Parker are the same age. They're both in fourth grade. And we both have older kids. It's a little difficult to explain investments in the stock market to a fourth grader, not because they're not intelligent, but
Right.
They're still learning some basic math equations, and I generally start with what is cash versus credit, or
Yeah.
just because you swipe a card doesn't mean it's unlimited. Something has to back that up. But
Right.
they ask, and I try to not bore them to death with my explanation, but it's something I'm definitely going to educate them on
Right.
as they continue to get older.
Yeah. I mean, we talk about credit cards. We talk about, things like that. I mean, they'll ask me like, why do you have a rental Like they're just curious. And I try to, it's tough because you're driving or you're whatever, or you're trying to explain this high concept to them. Sometimes they'll ask me a question and I'll get going, and I can see Charlie like rolling his eyes like, oh my goodness, here we go. We can't just enjoy our Cheerios. We have to hear this guy ramble on and on. But when it comes to like factoring, like why you pick your certain investments, and I know you've talked about this a little bit already, but keeping the growth in mind, try not to predict the future. You get in, you start investing, and it's just a time, minimize costs, which is one of the arguments I think some people have against mutual funds, is that there's a manager and there's cost there, whereas index funds are low cost and pretty simple, pretty boring. And one of the things you said here was to ignore word of mouth of people who maybe are not experts in the industry, maybe who are just showing you their big fish and are getting you in. Is there something we're missing here when looking to select investments?
No, that's a pretty good list of factors. The first one that I would kind of gravitate towards is in the investment period. Each investment class has its own timetable, right? So, rental property, that's not something you're going to buy one day and next month make money off of it. It's a longer term process.
Yeah.
Crypto would be something that I don't know yet. It may or may not be a short term investment. It could be a long term investment, but it would appear you can make money pretty quickly in crypto. That's not a plug or a recommendation by any stretch. So liquidity, I don't know how much y'all have gone over that term, but that is important. Can you get your money out quickly if you need to? So obviously if it's a stock, it's something you can sell and it settles in 2 days and you have your cash. Real estate, I guess you could sell it quickly, but the market's going to dictate what you get for it.
Right.
So, I would say, ask your folks if they ever sold a house, how long did it take to sell at the price that was acceptable to them? Now might not be a good time to go into that because it's the real estate market. Houses don't stay on very long, but volatility, that's something. If you look at crypto, look at some of the Bitcoin, look at Bitcoin chart for as long as it's been tracked, and it probably looks like an EKG machine going up and down. And so that's volatility. Can you stomach the volatility? Because things go up, things go down, things stay sideways. The number one, I wouldn't say the number one rule of any investment, but an important one is you want to buy low and sell high, right? And so you got to look at it from a risk tolerance standpoint. Are you going to sell when it's going to the bottom, or are you going to hold on to it? So all these peaks and valleys, if you would have held, right above, say in the January 2021, where it took a dip, you may have had a lot of people sell because they're thinking, oh my gosh, it's going to crash.
Yeah.
But if you just stayed invested, it went back up.
Right.
You can actually draw a straight line from where you're at all the way to the end, and it's still a gain.
Yeah. Right. I mean,
Now, I'm not an expert on,
64,000
cryptos a little bit.
64,000 to 30,000. I mean, it's just like, I mean, and it's not even like, it's not the quote unquote COVID year being 2020. It's 2021. It's just this massive volatility. And I don't know that everybody has that kind of stomach to, to deal with that.
They don't. They don't. And that's a great point. So that's when you're going into determining how you're going to allocate your money, which, not to get off on a side note, but you have different buckets of money, right? You have money that you need for everyday use, your bills, your non-negotiable items, right? So when you're adult, you gotta eat, you gotta pay insurance, you gotta pay taxes, medical bills, gasoline, etc. Those are not, they're not fixed costs because they can go up and down, but you have to have those. Those are if we're looking at like Maslow's hierarchy of needs, well, there's one for investment. Those are your I can't remember the term anyways, but essential. Those are your essential needs. So once you have money to cover that, then you would look at having money for emergencies. If there's an old rule that says have 6 months worth of your salary in savings, and then that's relative to different people. After that, then you have money for retirement that you're plugging away at. After that, then you have more discretionary money that's when you start looking at, okay, is this a short-term goal? Is it a long-term goal? Using those to determine how you're going to allocate your dollars. Like if I didn't have any money in savings, I probably wouldn't be invested in anything. I would want to build that nest egg like cash. It's boring, but you always need it. Let's see, inflation's relative. A general rule of thumb is say inflation's 3%. It's not. We really haven't had it in a while, but you want something that you're investing in that gets a better return than the rate of inflation. Otherwise, you're not making money. You're losing money. You're losing purchasing power.
Yeah.
So if inflation's 3% and a bond is paying 2%, yeah, that bond's safe, but your dollar's actually worth less.
Right.
That bond's paying 4%, you're beating inflation by 1%. That's a safe investment. And I'm not saying buy bonds.
Yeah.
But that's just an example.
We'll be talking about bonds. That's great. I'm glad you brought that up. As far as international strategies, is that part of something you think about, or are you just like, I'm good with US companies? What's the advantage to looking international?
There's lots of advantages to looking internationally. Number one is there's a lot of companies that, well, inherently you may be investing internationally and you don't even know it, because more and more of your large companies, they're international companies, whether or not they're domiciled in the US or not. Amazon, Apple, they're all based in the US.
Yeah.
But their revenue comes from all over the world. Apple may actually generate more revenue overseas than it does in the US. So looking at that, there's opportunity. Yes, I would say diversify and own international companies. You can do that via an index mutual fund, because there's lots of foreign companies that are global conglomerates.
Yeah.
A lot of, pharmaceuticals, things like that.
Yeah. Coca-Cola, McDonald's. I mean, they're all over the world,
Right. And even if they're domiciled, and what I mean by domiciled, like they're based somewhere else, like in Switzerland, if it's a pharmaceutical company, like Novartis or Sanofi, there's banks, there's all kinds. Yes. International is a good way to diversify your portfolio, because, barring a global meltdown, those markets may act a little bit differently than the US markets. Sometimes it's kind of a seesaw. The US markets or up, international markets may be down, or vice versa.
Yeah.
Um,
Interesting.
but
So,
yeah,
when you pick stocks, I don't know if you buy stocks specifically, but like maybe you buy everything in a diversified situation, but common stocks versus preferred stocks that pay you a dividend every month. If preferred stocks provide a dividend, then why don't everybody only buy that? Why do they buy common? Like, why don't, I'm curious about that. Like, why don't people only buy preferred stocks?
sure. So common versus preferred stocks are going to be, they're not a bond, but they act like a bond. Most preferred stocks are issued at, say, a $25 price, and they pay generally a higher dividend than their common stock counterpart. And those dividends have rights above common stock. So, for example, if GE suspended the dividend because they were in some, had some liquidity issues, whenever they reinstated that dividend, preferred stocks have priority over common stocks.
Yeah.
Now, preferred stocks, if you own preferred stocks, they have no voting rights. Not that many people vote proxies that they get, because you really need to be a major shareholder. They don't have any voting rights. Common stock or preferred stocks don't really, you're not going to see the appreciation in the share value.
Yeah.
They're going to hang around a range. When interest rates go up, the values of those are going to go down.
Yeah.
And vice versa. Preferred stocks are very similar to a fixed income investment, like a bond. They're not a bond because you have no, in a bankruptcy situation, whether you own preferred stocks or common stocks, you're way down on the pecking order as far as getting your money.
Yeah.
Bondholders, or quote debt holders, have a higher pecking order. I really stay away from preferred stocks. That's more of a way to get just income. So
Yeah.
you'll see older people who want, that fixed dividend,
Yeah.
own preferred stocks, but you can get dividends with common stocks as well and have that growth potential for the stock value to appreciate.
So last question here. I know I've kept you longer than I told you.
No.
Stock splits. Are you excited when Apple splits, when Tesla splits? Is that a good thing? Should people be celebrating in the streets that they now have 5 shares instead of 1? Or are we celebrating for no real reason at that point?
It depends. So a stock can split for a variety of reasons. It can split because the share price has reached a level where there's not as much volume being traded because it's prohibited. A stock that trades at $30 has more volume than a stock that trades at $2,000.
Right.
And so a split, whether it's a forward split or a reverse split, and what I mean by that is, 4 shares to 1 share or 1 share to 4 shares. So if you had, let's say, $1,000 stock and it did a, 1 to 5 reverse split, then for every share you had, you would get 5 shares worth $200. You still have the same amount.
Right.
It's still the same price. It's more of an accounting method, but it's also a way to make it more appealing.
Yeah.
The flip side is if a company is doing poorly, and say the stock's trading for $5, they may do a 5 shares to 1 share split, so the stock price goes up, even though the price has gone up, it's not worth any more or less. But in a case like Apple or Tesla, you're hoping that stock, when that splits and you get more shares, that it's going to keep its upward trajectory and keep increasing in value. And now you've got more shares. So it can be a good thing. It can be a bad thing, meaning a company is just trying to stay afloat because
Yeah.
once a stock drops under $5, it's classified as, quote, a penny stock and stops trading on major exchanges. But sometimes it can just be a non-event.
Yeah. Interesting.
So it depends on the companies. Apple, yes, I would be excited when Apple split.
So I've got about a minute left here before my kids break down my door here. But is Amazon going to split? I mean, they're $3,500 a share. Would it be advantageous to them to split in 5-to-1, where, you know, shares are now $700 instead of 3,500? Would they then get more volume? Why wouldn't they do that?
It depends. And I don't pretend to know Amazon's financials. I haven't really looked at them.
You don't know Jeff
but,
Bezos? Come on now, Aaron. You know people.
Yeah, no, I know. Yeah, no, we don't run in the same circle. But it depends. I'll give you an example of that. You know, so Apple got up there in price and it split, but Apple also started paying a dividend and it unleashed some of its cash stockpile. I don't know if Amazon will do it. It just depends. An example of is a little bit different than a stock split. So if you take Berkshire Hathaway, there's two share classes of Berkshire stock, A and B. The A class of Berkshire stocks trades for $200,000 a share.
Yeah.
Not a whole lot of people are buying, you know, have the ability to buy that. The B share trades at, you know, $150 to $200 in that range, depending on the year. A lot of people own that. So instead of splitting the stock, they created another share class of that stock, which I don't want to get into how that dilutes shareholders.
We'll talk about that though in class. I appreciate bringing that up. Yeah.
Dilution is important. I don't know about Amazon. I mean, at $3,500, that's pretty pricey.
Yeah.
Because if you're buying individual stocks, you want to try and buy what we call a round lot, which is 100 shares, because that order gets filled completely. I don't want to get into that, the way stocks get filled or not. But buying one share, you're not going to get as good of a price as if you buy 100 shares.
Okay.
Because when you pull up your little the Google or Yahoo, there's a bid and an ask price. That's called a spread, and that's the difference between what someone is willing to pay for it versus what someone's willing to sell it for.
Well, man, Aaron, I appreciate your time. This has been fantastic, as I've learned some stuff here. This is good. I know my students, I'll probably call you back again in February when we go over our real estate market as well. Well, thanks so much, man. I appreciate you.
Yes, sir. Y'all have a good one. Thanks, Brian.